Hi, we're Group 6 and this is our final presentation for the class Trading Room Workshop. Here is our agenda for today. Let's first discuss our group's final positions. As of 27 November 2018 at 4 p.m. Hong Kong time, our group made a loss of 7.8% over the trading weeks, with a net liquidation value of $921,800. There are several stocks that we have not closed. Each stocks were roughly around $75,000. Here is our consolidated portfolio allocation. The three biggest trades we made includes Amazon, which contributes to 22.1% of our trades, Google with 8.7%, and American Express with 6.4%.
So moving on to our trading record, including our performance and strategy. The first one is our trading strategy that we made on our very first week of trade. We made sure that every trades we make satisfy 5 out of 7 of our whole indicator checklist. And each stock we put 50,000 per trade, which we decided to expand it after week 2 to 75 to 100. It kind of depends on the industry riskiness and the overall stock performance. And we do these to actually achieve a profit of 5% on our very first 2 weeks of trade and 7.5% on the remaining 5, and make sure that we did not lose more than 2.5%, which we decided to expand it a little to 5% after week 2, because there were times that our stock got immediately sold off because of the fluctuation of the stocks. We try our best to diversify the stocks, not only to focus on tech stocks, but also on defensive stocks like household stocks, energy, utility, mining, and also TMT stocks. So our entry strategy, we have 7, as we said earlier, and we try to make sure that we satisfy 5 of them. The first one is 5-day moving average, good candle, in this case meaning the candlestick patterns, volume increasing, MACD patterns, and also making sure the BB, so we could see if the stock would do any reversal in the future. And also for long and short, we did have 2 different checklists. For long, we make sure that it is an uptrend and the RSI is under 70, so make sure it's not overbought. And for a short checklist, we make sure that it's a downtrend. And also the RSI is above 30, so it's not oversold. So our trading performance on our very first week, we did loss less than 1%. And then for the next week 2, we gained 4%. This was thanks to Abbott's contamination story and also new cores downgrading credit rating by Credit Suisse. And then we start investing in Adobe and also Delta. And on week 3, we did actually lose more because of the tech. Respectively, we see S&P 500. They also went a little bit low on October 30th. And then from week 4 onwards, we did lose a little more. And we did try day trading on November 20th. It did not really suit us. It did not really work. In the end, we lost 7.82%. As for S&P 500, it was highly affected by the earnings announcement and also the tech drops, which in the end they dropped 6.9%. By conclusion, we could say that we underperformed the whole S&P 500 index. As for HSI, HSI dropped 1% in the end, but we didn't really focus more on the HSI movement because their fluctuation was highly affected by the S&P 500 fluctuation, and we did only 5 stocks, 5 trades for Hong Kong stocks.
Next is our portfolio analysis, beginning with our best 3 stocks: Trading Clorix, gave us our largest profit of 8.61%, closely followed by Facebook, where we had a profit of 5.81%, and PNG, where we had a profit of 5.73%. On the other hand, were our three of our worst trades, which contributed to the overall loss of 7%. Adobe was where we had our largest loss of 16.13%, as well as MasterCard and Microsoft, where we had a loss of almost 10% each. Moving on to our technical analysis, we used a number of indicators to assess the market on whether to short or long a stock. And the first one we used was trend. So looking at strong uptrend or downtrend, we evaluated whether to long or short the stock. Trading Clorox, in this case, we observed a very strong uptrend beginning from May, and that resulted in our profit of 8.61%. While, however, looking at the strong downtrend of EDFC, we resulted in a loss of 2.11% because we should have had been more careful with the daily volatility of the stock. Next, we were observing channel, and in the case of Facebook, it was very effective as we noticed a strong channel starting with October, and we decided to long the stock as the prices touched the lower channel line in order to gain while the prices move up, and we had a profit of 5.81%. However, looking at the sideways channel of Kinder Morgan, we decided to long the stock here, hoping that the prices would go up. However, the next day, the prices broke below the channel line, and we resulted in a loss of 5.84%. We also observed a number of candlestick patterns to assess the stocks. Starting with this example, for Delta Airlines, we observed a 3 inside up here, which suggested that the prices will increase. Therefore, we longed the stocks here and gained a profit of 5.26%. However, in the case of Coca-Cola, we also observed a 3 white soldiers pattern, which suggested the price will continue to increase. And we waited for a few days to confirm with the other indicators and decided to long the stock on the 31st October, which resulted in a profit of 5.64%. On the other hand, candlestick patterns weren't as effective for us all the time as in the example of United Rentals, where we observed a doji star bullish pattern here and decided to long the stock the next day, hoping that the prices will increase since the trend will reverse. However, the next day the prices dropped and we had a loss of 6.98%. Similarly, with Nucor, after we had shorted the stock here, we observed a butterfly doji suggesting that the prices will increase. Therefore, we longed it the next day. However, as you can see, it did not, and the prices decreased. So although we had a profit of 1.23%, we could have had more profit if we had not observed this and continued to hold the stock for a little longer.
Next, let's move on to MACD. MACD has been a very reliable indicator since we began using it, and we have not found an instance where it indicated a wrong signal throughout our trading weeks. Our trade for Clorox is a very good example for this indicator's reliability. The MACD line has just crossed the red from below, indicating a bullish signal. Following this, there was a strong uptrend. Abbott's Laboratories MACD signal were also on the spot, although we chose not to follow this indicator at that time. Following after the MACD red line crossed the blue from below, Abbott's stock showed a downtrend, and the opposite is true after the red line crossed the blue from above. We have also relied on RSI a lot throughout our trading weeks, but its reliability has not been very stable. Our trades with Alibaba showed a time when RSI has been right on. RSI has just crossed 30 and soon after the price of the stock went up. Our trades with Procter and Gamble, however, showcase a time when RSI wasn't reliable. RSI crossed 70, indicating that the stock might have been overbought and there might be a reversal of trend. Therefore, we decided to close our position on the stock. However, the uptrend continued after we closed our position.
So I'm going to talk about the market conditions and some of the limitations we faced during our trading horizon. The first market condition or macroeconomic condition is the US economy. So the outcome of the US economy, specifically the Q3 GDP results, actually affect the S&P 500 and the HSI as well, as investors are really curious to know how the economy performed and also what's the outlook. So the US GDP in Q3 grew at a rate of 3.5%, and it beat Wall Street's estimates of 3.4%. And markets reacted positively to this news, as we can see from this graph here. It actually jumped up. Now, the majority of this growth in GDP was driven by the consumers. As we can see, consumer spending increased by 4%. So we know that some of the tariffs and tax cuts actually encouraged consumers to spend more. Unfortunately, this bullish trend for the S&P was short-lived, as the market went back down again, and I'll sort of explain why. First is that business spending decreased at a rate of 7.9%, and business investments decreased as well. Next, the Fed announced further rate hikes for December 2018, specifically two. Then we can see that even though the economy grew at a rate of 3.5%, this is still lower than the 4.2% in Q2. And the outlook for Q4 in 2018 as well as 2019 suggests that the economy will slow down. Now, all of these news essentially was viewed negatively by investors, and that resulted in the S&P moving into bear territory.
Now I'll talk about political instability. The trade war was a common theme throughout our trading horizon. It influenced market movements and in general made investors more risk averse. Hardware manufacturing and firms that had supply chains in China were the ones most affected by it. Now we experienced the effect of fake news firsthand. Many reports were released that showed an agreement had been reached between the two countries, and markets reacted positively to this news, and we bought stocks reacting to it as well. Unfortunately, soon this news was deemed to be fake, and the markets came crashing down, and we ended up losing a lot of money. We soon realized that we couldn't trust news even from credible agencies such as Reuters, Wall Street Journal, or Bloomberg, and we only had to rely on official pieces of communication from the governments. Looking ahead, the trade war is still the number one concern for global CEOs, and there's potential for things to escalate further. Our trading period was short and proved to be another limitation as well, as we primarily engaged in day trading and weekly trading, and so our focus was on short-term growth stocks such as technology or financial institutions, rather than stocks with a long-term profit potential. We looked for short-term volatility as we could profit from sharp movements in stock prices, and so our strategy was classified as high risk with a high return potential. We faced certain difficulties when it came to using the IB platform as well. Initially, we attached separate orders for profit taker and stop loss, as we didn't know we could attach them to the same order. We soon figured out how to do this, but we are still faced with the following three limitations. Number one, we couldn't short ETFs in certain stocks using the IB platform. As we were primarily engaged in a bear market, this severely hampered our ability to maximize profits. Number two, the platform would sometimes submit incorrect orders. For example, if we bought 100 shares of company X, the platform would execute the order twice and we would end up with 200 shares of company X. Thus, we would take on more risk than we originally intended and had a greater potential to lose. Finally, the IB system delayed the market information by around 15 minutes or so for the S&P 500. As a result, when we would submit our orders based on the price that the system quotes, the orders would be filled at the market price, which would be completely different. We lost out on some opportune movements to maximize profits and incurred greater losses than expected as a result of this. Now, we believe the asset allocation constraint was a limitation as well, although it wasn't a big one. We couldn't use derivative products such as options, and if we could have used them to effectively hedge our risk and to buy commodities such as crude oil, which is in a bear market. We could have also increased the diversification effect on our portfolio, but overall we didn't feel this was too big of a limitation because it didn't hamper our ability to effectively trade stocks and to long ETFs.
So throughout our entire trading period, we came across some behavioral biases which adversely affected our performance. And so the first one is the myopic loss aversion, which refers to the tendency of avoiding short-term losses at the expense of long-term gains. So using McDonald's as an example, so here we long 500 shares and we decided to short it the next day with a 1.78% loss. So we decided to do that to prevent this loss from happening. However, if we had decided to hold a position for throughout the entire trading period, which is here, we would have had a more profitable result. Moving on, the endowment effect, which refers to us considering something that we own to be worth more than it would be if we did not. So here we are using Amazon as an example. We had a stop loss triggered here with a nearly 5% loss, and this one refers to the day trading part with a 0.424% loss. So throughout this period, we decided to continue trading even though we had a loss already, and so since we decided to hold it for a little too long, we had a loss for 8.96%. And media response was also another important factor where we felt the need to react to new information immediately, which could be irrelevant to the future performance of the stocks and causing information overload. So using BA as an example, we decided to short BA immediately after listening to an incident which suggested that the price would go down. However, the next day the stop loss triggered and the price was going up, so we had a 6% loss. And moving on to the irrational valuation of selling signal using PNG as an example. Our stock performance was going quite well up until to the point where we decided to close the position, and we decided to do that looking at the indicators MACD and the RSI. However, if we had decided to hold the position for a little longer, we would have had more profit. And finally, the Clorox company. So we decided to long 320 shares here, and the profit taker was triggered a few days later. So we had a profit of 8.61%. However, since the stock was doing quite well and there were signals indicating a buy, we failed to relong it. So because of our hesitation of the buying signal, we deprived ourselves of a further profit.
Now, we learned with respect to position size that we were quite conservative at the beginning. So this means that even though we were making a profit, it wasn't too substantial. So later we began taking larger positions to utilize our capital more effectively and to also, to seek a higher gain. Next, it comes to diversification. We didn't really diversify our portfolio initially, but when the downturn started in October, we began taking on more positions in certain utility stocks as well. And we essentially saw diversification had a positive effect on our portfolio. We timed the market effectively in some cases. For example, with Amex, PayPal, and Home Depot, we bought the stock before its earnings announcement, and after the earnings announcement, the stock price shot up, and we were able to profit a lot. Unfortunately, when we tried the same for Amazon, we ended up losing quite a bit. Now, when it comes to behavioral finance, we found out that we hold our loss positions for too long in the hopes that it would reverse. Secondly, we would begin to engage in more riskier trades in the hopes of offsetting some of the losses that we incurred. And finally, we would sometimes ignore these selling signals, and essentially we would sell the stock even when we made a slight profit, because we would panic and we wouldn't want to lose any more capital. Finally, we are more well aware of the IB system, we're aware of its limitations, and we know how to work around it, and we're more effective in using the system.